It's like nerds bullying nerds, isn't it?
Mr. Speaker! The Speaker!
Order!
I can't hear myself thinking here.
Sorry, I didn't quite catch that from the SNP. Did they not?
Guess what, guys? We're going to fix the country in 2028. So if you're anything like us, we've just painfully sat through an hour's worth of a political show watching the Chancellor deliver her budget on the outlook for the economy over the next couple of years. Now, I don't know about you, but it felt pretty underwhelming for large parts of it, especially where it comes to money, mortgages, and finances, which we'll break down in a few moments. Now, we don't always talk about politics on this YouTube channel, but we talk about money, financing, budgeting, everything in between to help you understand and make better decisions when it comes to your mortgages. I'm Sam Fox. Do me a favor, please like and subscribe to the channel. Let's get to it. So first things first, wages. A lot of us were expecting the income tax thresholds to increase, but the Chancellor came out a few weeks ago and said that's not going to happen because that isn't going to be a great idea. So the cap limiting households on universal or child tax credit from receiving payments for a third or subsequent child is going to be scrapped from April, so it's going to remove that. The legal minimum wage for over 21s is going to rise by 4.1% in April from £12.21 to £12.71 per hour. Now rates from 18 to 20-year-olds is also going to go up by 8.5% from £10 to £10.85. Woohoo! That's an extra 3/4 of a Snickers bar, maybe, this day and age. Who knows? Now, the basic and new state pension payments are going to go up by 4.8% from April, more than the current rate of inflation under the triple lock policy. But national insurance and income tax thresholds are frozen for an extra 3 years beyond 2028. So what that's going to do is drag more people into the higher bands over time. So as the tax thresholds stay there, people's incomes increase, you'll find more people tipping into that, paying more tax, raising more money for the government. Now, in terms of savings, under 65s can put into a cash ISA, which is an individual savings account. That's going to be capped at 12 grand a year, with the rest of the 20 grand out of the annual allowance reserved for investments into businesses. So you can still save the 20 grand, but 8 grand of it is going to be used for specific things. Now, basic and higher income tax rates on property, savings, and dividend income are going to increase by 2 percentage points as well. So all the landlords out there, all the business owners who are taking a dividend out of the business are now going to pay more tax. A good point to come of it is that the energy price cap will change, meaning that households in the UK will benefit from a reduction of about £150 per year in their energy bills, which sounds great. But reality, if you walk to the corner shop and get a few things from there, you're spending it there anyway, aren't you? A Mountain Dew, a packet of crisps, a Mars bar, and if the kids go with you, you're probably spending more than that in the local corner shop across the year. So it's 150 quid in our pockets, but we will probably not notice the difference. Now, in terms of the housing market, well, there's not actually too much to come from it we weren't expecting. We now have a mansion tax, which is a yearly fee for homes over £2 million in value. Now, if it is £2 million in value, you're going to pay a fee of 2.5 grand. If your house is going to be worth over 5 million, that's going to be charged at 7.5 grand per year. Now, a couple of things to come from this. There might be families who purchased decades ago and the house is increased in an area and they don't have income to support the extra 2.5 grand or certainly the 7.5 grand. So the government are looking at payment options, whether you pay that yearly, whether you pay it monthly, or whether you keep adding it onto a debt so that when you eventually pass away, you get taxed on the inheritance tax of your property and you've got to clear this council tax debt as well. So make of that what you will, but it's certainly affecting the higher part of the market. Now, from my point of view, not a lot is really going to change in the day-to-day mortgage world. Yes, there's going to be stress and pressure at the higher end of the market, but those tax implications aren't going to happen till 2027, 2028, I think I said before. So it's not going to be an immediate effect. So the London market or homes of a higher value, it's not really going to affect them in the next year, 18 months, but it will maybe affect them in the future when they're planning the sale of the house. But then I guess if you're buying a £5 million house and you're choosing to buy a £5 million house, the extra 7.5 grand a year is obviously going to be built into your costs. If your income sustains a £5 million a year property, working backwards at a lender that times your income by 4 times or even 4.5 times, you're earning a bit of a decent wedge. So it might not implicate you if you're looking to buy them, but it'll certainly implicate those ones who already live there and maybe under financial pressure as it is. Now, from my point of view, it's not speeding up the conveyancing process. It's not speeding up the housing process. There is still an affordability crisis. There is still a housing crisis. not a great deal's come from this budget that's going to support people in the day-to-day purchase of their properties, which, from my point of view, and selfishly, is a little bit disappointing. I was hoping for something that's going to pique the interest short-term in the housing market to help get people back on the property ladder. Looking at the Help to Buy scheme, something like that again would have been brilliant. Maybe, I don't know, just my opinion. But let me know what you think in the comments below. Tell me what you think of the budget, and if there was any changes, what would they have been that you've seen?